What's up, everybody? This is JT here with channel JT Invests in You, and today we're going to be going over the who, what, when, where, and why of investing. Alright, so first off, who should invest? You, that's right. You, sitting right there watching this. You should invest. Who else? Everyone else. Tell somebody they should invest. Many recommend judging your risk management based on your age, meaning the older and closer you are to retirement, the less risk you want to take on. The younger you are and further away from retirement you are, the more risk you, in theory, can absorb. A balanced portfolio often includes some allocation to bonds. Now, I personally do not like bonds. I think they're boring. However, it probably would be wise for me to tell you that they do recommend that a balanced portfolio has some exposure to the bond market. A great way to do this is through ETFs such as Bond, which is a bond, it's a ticker symbol BOND. It's an ETF brought to us by PIMCO, great financial institution. TLT, IEF, you can look all these up. In fact, we can exit this slideshow right here, go over to Webull, and look, we got Bond right here, PIMCO, Active Bond ETF. It's pretty safe ETF. You know, what else did I say? IEF, that's the 7 to 10 year treasury bond. Not ref, I hate, these autocorrects on the ticker symbols are annoying, but IEF, it's a 7 to 10 year treasury bond ETF. It's another great, safe, you know, they all do just about the same thing. All right, so back to this sweet little PowerPoint we got going on here, huh? Here's a trick. Take 100 and subtract your age. Now we'll go over that. Do it now. Have the number in your head. We'll do that in the next slide. The two approaches to bond investing. I know this first part's a little boring. We'll get it out of the way. But the two approaches to bond investing, you got the 80-20 rule. The 80-20 rule is simply a real basic way to do it. You got 80% exposure to stocks and, you know, things like that, and you got 20% exposure to bonds. That's pretty basic. Another way to do it is the trick in the previous slide, 100 minus your age. Now, I'm a 29-year-old, or I probably just hit the microphone, that might have sounded funny. I'm a 29-year-old man. Let's see, 100 minus 29 is 71. By this approach, I should have a 71% ratio of stocks and 29% ratio of bonds. As said before, I'm not a big fan of bonds. I personally don't often invest in bonds. I definitely don't hold them for the long term. Sometimes those ETFs mentioned before are a good place to park your money while the market's maybe being a little volatile, but otherwise, I personally, just full disclosure, I'm not a big bond person. However, in this example, say you're an 18-year-old, you're just starting to invest today. You'd take 100 minus 18 would get you 82. So in theory, for a balanced portfolio, you would have, and for your risk appetite as a young person, you'd have 82% stocks, 18% bonds. All right, on to the fun stuff. What should we invest in? Now let's just cover the basics. The basics include ETFs such as SPY, SPY, and QQQ. These are just index funds that track the market. SPY tracks the S&P 500, and QQQ, I believe, is NASDAQ. It's tech heavy. But yeah, let's just go check those out right now. Let's see. Let's give a little tab right here. SPY ETF. Oh, boring. Let's SPY ETF. Let's go to holdings. Just so you know what they've got. Yahoo Finance sounds good to me. And what do we got? top 10 holdings in SPY. It gives you exposure to Apple, Microsoft, Amazon, Facebook, Alphabet, which is the parent company of Google. There's two classes of shares for them. We won't go into that in this video. Tesla, Berkshire Hathaway, JP Morgan Chase, Johnson Johnson, and so on. There's many holdings in this ETF. You can see over here, it's allocation. So if you bought one share of SPY ETF, 6% of what you just paid for that share is exposure to Apple, and about 5.5% exposure to Microsoft, and so forth. So if you don't want to buy these stocks individually, you can gain great exposure to some of the top stocks in SPY. Now let's check out QQQ. QQQ is another great ETF. It's more tech heavy, as said before. Let's see its top 10 holdings. You've got about 11% in Apple, 9.5% in Microsoft. You've got Amazon, Tesla, Google, Facebook, Google again, Nvidia, PayPal, Intel. Bunch of great tech heavy companies. Tech has been getting slapped lately in the market. However, could be a great time to be buying the dip. And let's go back to our PowerPoint. Let's see. Slideshow from current slide. Let's go. Basics. ETFs. We got stocks. We got large cap stocks. Well, if you want to choose your investments individually, ETFs are great for broad exposure, but individual stocks give you obviously more flexibility and ability to, I guess, make your own destiny, I suppose. However, all right, speaking about stocks, you've got large cap stocks like Tesla and Microsoft. You've got mid cap stocks like NIO, which is a Chinese EV maker. I love NIO personally. Airbnb, small cap stocks like Curie. It's Curiosity Stream. It's basically a non-fiction streaming service. It's a great service, about $2 a month for the subscription. And honestly, it's amazing. And you got PaySafe over here, which is a leader in the fintech space, in the iGaming space. They have deals with like DraftKings and process payments, I believe, on Twitch and for Fortnite and so forth. Let's see, but then we've got penny stocks. I personally don't invest in penny stocks. I have here and there, but they're really volatile. I just don't have time to be paying attention to them as much. Then your FANG stocks. And your FANG stocks, it's an acronym. The FANG stocks are Facebook, Apple, Amazon, Netflix, and Google. These are all just really solid plays. They're not going anywhere. They're not going to have huge fluctuations up and down. And then cryptocurrencies like Bitcoin, Ethereum, Litecoin, Ripple, and so forth. Then we have sector investing, which brings us sort of back to the ETF market slightly, except it's, as opposed to broad indexed ETFs like SPY and QQQ, you can have more direct ETFs that invest just in a particular sector, as opposed to just like the overall indexing of the market. And now sector investing, as said, many ETFs target certain sectors in the economy. We can invest in for example, there's many sectors, but here's just a couple of examples. We can invest in the fintech sector. One of my favorites is ARC-F. We can invest in the genomics sector. One of my favorites is ARC-G. I do like ARC Invest. I recommend you checking them out. The gaming industry with ETF Hero, HERO, and the clean energy industry with ETFs such as QCLN. Let's look one of these up. Let's see what QCLN has for holdings. Let's see. QCLN over here for holdings. Holdings. Let's go down a little bit. Perfect. Top one for QCLN. Now remember, this is the clean energy one from the slide before. The full name is the First Trust NASDAQ Clean Edge Green Energy Index Fund, QCLN. All right, holdings. We got Tesla, of course, Tesla Energy, Enphase Energy. It's going to be a great play in the future. Same with Plug Power. Maybe not exactly right now, but 10, 15, 20 years in the future, I could definitely see these two companies being Enphase and Plug Power. Plug Power more so because they are more in the hydro space as opposed to battery space, but that's beside the point. Anyway, we've got NEO, as mentioned before, Chinese EV maker. What else we got? We got Solar Edge Technologies, a semiconductor company. We have Sunrun, another solar company. All sorts of great companies. Let's see. And let's look at this chart. Wow, look at this. If you had invested, what's today? Today is the 4th, April 4th. If you had invested exactly 1 year ago into this ETF, wow, you would have more than tripled your money. That's impressive. Anyway, you know what? While we're at it, let's look up SPY just so you can see the overall market. People are always worried about a crash, always worried about this and that, this and that. Here's the overall market. Let's go to max. I don't know what all these D's are for. Oh, showing the dividends. I don't really care for that, but that's okay. Anyway. Okay, even this big crash, this was the bubble in 2000. Yeah, the pretty much the crash everyone's always afraid of, right in 2000. But even if you bought at the top of this crash, and you held on to it, or just kept buying, you kept averaging in here and averaging in here, and you kept buying all along, even buying this great dip here, you'd have a stellar return, a real stellar return. After every market crash or recession we've ever had, the market's always recovered and hit new highs. This one was a slight new high, and then we dipped again, and now we're in a massive new high. And this only goes back 20-ish years. You know, you can trace this back much longer than that, and it's at least in the United States economy is robust and markets recover. People like to say, "Oh, Japan's stock market never recovered." Like, we are not Japan. We are certainly not Japan. I have no doubt in my mind that even with a market crash, we will recover to new all-time highs. In fact, I do not fear market crash. I see market crashes as amazing buying opportunities, and I would have loved to. Most people get terrified in a market crash, and as things are running up, you know, they're running up, they're getting all euphoric, everyone's super happy. That's when everyone starts to invest. Everyone starts to invest, like right around here, because it's euphoric, everyone's making money. And then this happens right here, and people get scared, and then they start dumping their money out right here. They start selling out right here. They start selling out at the bottom, when this is where you should be buying. I mean, I know it's hard, but I don't know what's happening right here. Yeah, I know it's hard, but you got to be buying right here. I know it's hard to think, oh, I'm going to be buying more as you see your money just plummeting. But look what would have happened if you did. You would have, in SPY, one of the most boring ETFs out there, freaking went up like 5x since this dip in 2009. Like, that's insane. You go over to this dip over here after COVID, and it went from 337 to 227. That's probably like a 35-40% drop. That's hefty. Maybe a little less, like 30%. I don't know. I'm not doing math right now, but that's still a hefty drop for a solid ETF. But if you bought right here at 228, it's at 400. That's nearly a double. That's nearly a double on an ETF that typically returns maybe upwards of 10 to 15% a year annualized. Like, That's pretty amazing. You really got to be buying the dip. Whew. Imagine not buying the dip. Whew. Couldn't even. Let's continue though. So we got what to think about when investing. What will the future look like in 5 to 10 years? It's an amazing question to ask yourself. What do you think the future is going to look like in 5 to 10 years? Are we going to have a bunch of gas vehicles everywhere? Are we going to have, maybe solar roofs everywhere? Like, what's a change that you see? Is blockchain going to replace banking? Are we going to be voting on blockchain technologies like an Ethereum protocol where we cast our election votes on a decentralized platform? What do you think the future looks like? Think about that real hard. What causes do you support? What businesses do you support? Are you big on, let's see, are you big on green energy? Are you big on blockchain? Do you think gaming is amazing? Are you big on electric vehicles? Do you think there's an industry out there that's revolutionizing the way we see the future? And if you do, it might be best to put your money there. Now, when should we invest? This is a great question because people love to time the market. But let me tell you, don't do that. Just don't do that. When you look at a chart, you want to be like, oh, I wish I bought the bottom. I wish I bought the bottom and sold the top. But when you do, and you're waiting for that bottom, usually you wait too long. And you're like, oh, this price is really low. I'll wait till tomorrow. Maybe it'll go a little lower. And then tomorrow comes and it's 5% up. And you're like, I don't want to buy. This is probably just what they call a dead cat bounce. It'll keep going back down. And it doesn't. And next thing you know, you're forced to buy in when whatever you were looking at is now 15% high off its lows. Just don't try to time the market. And same thing with the tops. Everyone wants to sell the tops. But usually what happens is the top pops and it comes down 5 or 10% and nobody wants to realize that that's the pop, and they think, oh, it'll come back up, and then it goes down another 5 10%, it goes down another 5 10%. Just don't try to time the markets. You should invest now. Invest right now. I know by the time I upload this, it's probably Monday, but right now it's Easter, so you can't invest right now, but you can get some money together, get into a bank, put it into a brokerage. You can start that process now. Now here's a great quote I love. Time in the market beats timing the market, and I think this is 100% true. I've learned from my own mistakes, honestly. I have tried to time the market, and sometimes it works. Sometimes you feel like a genius, but it's often luck, honestly. Sometimes you can do some technical analysis and what have you, but markets don't always behave to technicality. So lots of studies have shown that the majority of investors make more simply by investing and continuing to invest. That is, say you get a bi-weekly paycheck, you put 10% of that paycheck in every 2 weeks, and you just keep averaging in, whether the market's up, whether it's down, you just average in and hold on to that for 5-10 years. And so averaging in over long periods of time versus their counterparts that try to time the markets ups and downs, typically the investor that's averaging in over a long period of time, not worrying about the daily ups and downs, end up with a higher rate of return than those that do worry about the daily ups and downs and try to time that market. It's just not worth your time. It's not worth your stress. Just invest and keep on investing. And that's pretty much it. One of Warren Buffett's favorite things to say was invest and do nothing. And that second part was the most important part. Now, where should we invest? What a great question. I have a list of brokerages that are about to come up that I personally use. I love them all for various reasons. There'll be links in the description below for all of them. Each of them, I think like 5 out of 6 of them give you some sort of reward for signing up with them, and they reward me as well. It's kind of a great way to support the channel that's just starting off, but let's get into it. We got Acorns. Acorns, really simple app. If you sign up using my link below, you get a free $5 just for signing up, but it's really simple. You basically can set it so you can just invest whatever you want to invest. And if you don't want to invest money directly, that's fine. You can set it up on your debit card so it does automatic roundups. So say you spend, I don't know, like $1.25 at the store, it'll round that up to like $2 and it'll put that 75 cents into your Acorns account. Or you can multiply your roundups, so you can do like roundups times 5, so it'll take that 75 cents, multiply it by 5, and invest that. So like it basically, every time you swipe your card, a little bit will, like, the change will essentially be rounded up and invested, obviously, if you have that feature on. It's honestly great. You don't even realize it's happening, and every now and then I open up my Acorns app and I'm just like, oh, that's pretty cool. They'll ask you a couple different questions like your risk tolerance and things like that, but they basically just invest your money in really simple ETFs, like some of the ones I showed you before in previous slides. Now, we've got Robinhood, which I use the most. I know a lot of people hate on Robinhood, but I love it. Besides, sometimes its desktop version works slow on my desktop, but that's okay. Robinhood is great for many reasons. I think its user interface is honestly the best user interface I've come across. I like that they don't allow you to short stocks, so you can't over leverage yourself too much, which is good for new investors. You don't want to end up in a situation where you made a bad decision and now you're negative money. You don't want to do that. You can't be negative money on Robinhood. You could lose all your money. I mean, investing's risky, obviously, but like, you won't be negative money in it. And if you could short stocks, there is a possibility you could be negative lots of money if you make the wrong bet. So it's nice that Robinhood doesn't allow its new investors to pretty much be upside down on their investments like that. And of course, if you use the link below, you'll get a free stock. I'll get a free stock from Robinhood. It's terrific. Next up, we've got Webull. I love Webull to some degree. I don't think its user interface is as good as Robinhood's. However, Webull provides way better data analytics. Their charting software is better, and they offer 2 free stocks. So that's better too. Who doesn't love free stocks? So use the link below. Check out Webull. Next on the list, we've got M1 Finance. I personally, I know I just said I love them all. That's why they're on my list. But M1 Finance, for me, has the second most amount of money invested into their brokerage. I love M1 Finance, but it's not where you go to day trade. You cannot day trade. You only have 1 to 2 trading windows a day. 2 if you're a pro member. This is an investing website. It's pretty brilliant. You can create what are called pies, and they're essentially your own version of an ETF. So say you picked out these like 20 different stocks and you love them, and you put them all into this pie, and say you want your money, you want 5% of your money to go to Tesla, and you want 4% of your money to go to Sunrun, and you want, and so forth. You can set it all like that and then invest directly into the pie itself, and the computer software will spread your investments as you told it to, essentially, as you've allocated it, instead of having to individually go and buy 20 or so stocks and do the math to figure out, like, all right, this is a 6% exposure, or blah, 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 blah. It's a wonderful tool. It has rebalancing features too, so if certain things get out of whack, like say you've got a stock that you only wanted to have it be 6% of your portfolio, but it went on a run and now it's 12% of your portfolio, you could rebalance it. It would sell stocks that are over the allotment that you want it to be, and it would buy stocks that are under, which is great, because then you're essentially just like always buying the dip on the stocks that are under your allocation amount. It's pretty amazing. Number 5, if you like cryptocurrencies, I think we should all have some exposure to cryptocurrencies. Really, that 80-20 rule should be changed. That with the bonds, like, we should really have a 3-part rule now, maybe, and have stocks, crypto, bonds exposure. But you come up with your own ratios, see what works for you, obviously. Coinbase is my investment app of choice for cryptocurrencies. Obviously, there are websites like Bittrex and Binance and so forth, but I think Coinbase is a great place to start off. Plus, We both get a free $10 if you sign up. And then lastly is TD Ameritrade and Thinkswim. I guess that might not be actually last. Nope, it's not. TD Ameritrade and Thinkswim, I use their charting software far more than I actually have yet to invest on their platform. But I do have a TD Ameritrade account. I do have money over there. I do use their charts a lot. And they allow you access to OTC stocks, which are over-the-counter stocks, which Robinhood and Webull also, and I think M1 Finance don't give you access to most OTC stocks because they're riskier. And same thing with Fidelity. I do use Fidelity for my 401k and 403bs and blah, 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 basically for mostly just my retirement investing. I have yet to use Fidelity to place a trade also, but I do use all 7 of these. For some reason I thought I had 5. That's silly, but I do use all 7 of these. I would recommend all 7 of these, and of course links will be in the description below. You can get free stocks, free money, blah, blah, blah. Let's go. Why should we invest? That's a pretty wonderful question if you ask me. No one ever got rich from purely saving money. Do you know a single person who got rich from saving? Just doesn't happen. It just doesn't happen. Investing gives us the ability to build our wealth over extended periods of time. It might seem flashy. You might see people posting on like Snapchats about their Discords or even on YouTube about making money quick. And there are some investors that are really good and they're really good traders, really good stock pickers. They can make money quick. However, there's also people that create a chase, and then you have people chasing the hype because they see people getting rich or what seems like rich. It could be fake. You can't trust anything on the internet, but you see people seemingly getting rich, and lots of people pile in and follow their footsteps, and that can be dangerous because often you're buying into something that's already at its peak, that's just about to pop. Really, wealth building takes time, and you need patience, and you need to not trade with emotion. You need to not invest with emotion. The goal, for me at least, is financial freedom. The ability for your money to work for you, so you don't have to work hard for it. It's a beautiful thing if you can get it to work for you. Investing also gives us a great outlet to put our money where our mouths are. There are many great businesses and industries completely revolutionizing our future, and your investments can help shape that future. Now, a lot of people don't realize this. They think they're just investing, they're going to make some money or lose some money, hopefully make some money. But what you're actually doing when you invest in a company is you're essentially allowing this company to use it. As you invest in a company, as its market cap grows, these companies are able to take out bigger lines of credit or better loans, or even better yet, they can, well, some people might not say better yet, but they can do another direct offering. If their share price goes through the roof, say their share price doubles, they can do a direct offering and sell more shares to the market. That does dilute the shares, but they could sell more shares to the market, raising capital off of these shares and reinvesting that into their company. So, which is why I love growth companies, small companies that are going to grow, because not only are you investing and hopefully making a high rate of return, but you're also helping a company that you might love change the future. It's pretty amazing. I'd say with the bigger companies, this isn't as much of the case. I don't see Apple doing a direct offering soon. They've got plenty of cash. Of course, but with the smaller companies, for sure, those investments can go a long way for you and for the company, and depending on what the company's doing for the world. We got some pro tips coming in. New investors should avoid these things, and I'm only saying this because I fell victim to most of these things, and I'm just letting you all know. Don't trade. Don't day trade. Don't swing trade. Just invest. Invest and hold. At least for now. Until you get the hang of it. Until you understand a little bit more of things like technical analysis and investor sentiment and know a good researching process, you really want to avoid trading. Trading seems fun and exciting, but most traders lose money. Let's just be real. It's definitely true. Most traders lose money. You want to be an investor. Avoid panic selling. When the market is crashing, when the market's going down, don't panic. The worst thing you can do is panic. If you bought into companies or ETFs or sector ETFs that you believe in for the long term, for the next 5, 10, 15 years, don't panic sell. In fact, see it as an opportunity to buy more. If your stock is down 20% in a week or two, I mean, there's potential you might have chose a bad stock. But if you didn't, let's just say you didn't, you chose a great stock, it's going to be something a company that's going to be around for the next 5, 10, 15 years, making profits, changing the world. Don't panic sell. Buy more. Like, why would you, your stock's on sale. Why would you sell into this and realize potentially a loss? You don't even have profits or losses until you sell and confirm it. It's all just numbers on a screen until you just don't panic sell. Now the opposite, the reverse of that, don't FOMO buying. FOMO is the fear of missing out. They see stocks going to the moon. They see people on Reddit, maybe on Twitter or on YouTube even, and in some future videos I'll be going over some stocks I like, but don't FOMO buy into things that are being seemingly pumped up by some internet crowd somewhere. It's just, you can occasionally jump on the momentum of these trades and ride it out a little bit, but it's dangerous. Like, they're going to go up and they're going to come right down. Don't FOMO buy into anything. Don't buy or sell with emotion. Buy or sell with conviction and with purpose and with reason. If the company, say, isn't hitting its quarterly projections and it's losing more money each quarter or something, then maybe that's a reason to sell. But not because the stock market's down 5% in a day. Like, if the stock market's down 5% of the day, but the fundamentals of the company are still good, why wouldn't you buy more or just hold on to it or close the app and not look at it? Like, I don't know. Number 4, we've kind of just already gone over this, but don't chase stocks from Reddit pages. Alright, everybody, that's the end of the video. If you liked what you saw, please subscribe, like the video, comment down below, let me know what you want to see in the future, let me know any tips for how I can improve the video, whether it's, vocal cues, anything from software to use and tips on, literally anything and everything. This is a brand new channel. I want to make it great for you. I want you to learn. If there's anything you want me to go more in depth on, like you want me to do a deep dive on all of those brokerages I mentioned, or certain ETFs or stocks or anything you can think of, just leave that in the comments below. I will be reading those. I will be putting those comments pretty much into my notes and probably into my videos soon. So I appreciate the time you've spent with me. As said before, links in the video description below for Webull, Robinhood, M1 Finance, Acorns. If you use all of 4 of those links, Coinbase too, if you use all 5 of those links and follow the steps, you'll get at least, I think it's at least like $60 total, because you're getting $30 from M1 Finance right off rip. You're getting $5 from Acorns, that's $35. You get $10 from Coinbase, that's $45. And then you're getting 3 free stocks total, 1 from Robinhood and 2 from Webull, valued anywhere from like $5 to a couple $100, I think, a piece. So you could, in theory, make a lot more off these links. So check them out. Thanks for viewing. Thanks for sticking around. Share the video if you like it. Give us a thumbs up. Subscribe. And this has been JT Invests in You. We're out.